Okay, for this video, I'm going to do a little bit of a deep stock dive into Riocan REIT. It's one of the biggest REITs in Canada, and it's actually one of the longest companies I've owned. I haven't owned it for very long. I don't tend to hold things for super long, but I have this one in my RRSP. It's one I haven't really looked at recently. Not for a while anyways. I just kind of been reinvesting the dividend, but I looked at it recently and I was kind of shocked at where it was at. So I wanted to double check if this was still a good investment or not. So yeah, I'm going to do a little quick review on this one. Let me know what you think in the comment section below. But let's get into this. So the first thing I do when I'm reviewing stocks is I check out the stock charts. So I know a lot of people don't like to do this, but I think it's crucial to get a really good idea of the sentiment in the stock. And the first thing I noticed here was, okay, we're in mid 2024, and I'm looking at this range bound here. And it's been range bound here. It's at the bottom of the range here around $17.50. And the top of the range has been $18.50 for the last basically 6 months. So immediately, this is not a good sign for me. This is not juicy enough. This is not interesting enough. So I'm getting negative vibes from it just from looking at this right here. It's just showing you what retail's doing, big money's doing. And generally, this is a pretty boring stock. It's not doing a whole lot. It's kind of trending down here. So let's like zoom it out. And here we go. I zoomed it out 5 years. So my average on this is about $17.50. So I must have picked it up somewhere around here, the end of 2020. And I've been reinvesting the dividend, so it's increased my cost base a little bit. But I remember this. So this is a nice little run. I was actually thinking about adding on to Riocan right around here, around the $22 mark. And I never did, thank God, because it popped up here. This was when interest rates were super low. 1-2%, and real estate was red hot. Of course, it's come down, and I actually didn't realize it was taking such a beating. Yeah, it's been a wild ride, but it's already back down to my cost base, which gets me a little bit nervous. I don't want to go in the red on this after holding it for like 4 or 5 years. Not great. We're at $17.50, and I've also noticed this is it's kind of trending down. It pops up, and it comes back down deeper. It pops up, but not as high, and it goes back down even deeper. Again, these are not giving me great vibes. You go out 10, 15, 20 years, and this chart to me doesn't inspire a lot of confidence. So I'm already second guessing if this is a good investment or not. Might be one I have to sell from just looking at the charts. But you know what? This is in my RRSP. This is something I was planning on holding long term. So let's go a little bit deeper into this one. Here's the corporate presentation, and I'm just going to say this right off the bat. These are very obviously investor-friendly, positive outlook that they want to showcase. So if you don't know anyways, Riocan owns a lot of big shopping malls in major cities. You know, they do a lot of these big towers right here. So they do retail at the bottom, have shopping malls, and etc. And then above, they've been doing offices and residential. And at a glance, here it is. They're on all the major markets in Canada, which is great. They're really big in the Toronto area, which is awesome because that's where all immigration basically goes. It's going to go to the major city. They're not going to go out into some, Winnipeg or whatever. It's just the majority of people are going to end up in Toronto, they're going to end up in Vancouver, they're going to end up in Montreal. Alberta got some decent assets, but you can see 85 all in the greater Toronto area, 35 in Ottawa, East Coast base, Ontario base there. So there you go. An okay credit rating for what they are. Occupancy rate, 97%. It's actually pretty good for retail. They're basically saying, you know what, we're pretty much full here, 98%. Which is great. Growth isn't great, but I guess they're saying they're on track. I don't see anything exciting about 2.3% year-over-year growth. Now, I will give them this. I do think Riocan's got probably the top quality of retail rental units in Canada. They're all located by transit. They're all big towers, big communities, which I think is right here. Like all these big buildings, that's That's what they do. Yeah, so they're all in the major markets. They don't go into any of the second tier, third tier markets, which is what I love about them. And of course, look at this. They just dominate Toronto here. You can see they're all super close to subway lines, new subway lines coming in. They're clustered together. High income, that's big. They're in downtown Toronto. The wealthiest people, these are professional like dentists and lawyers renting these places out. So they're going to keep higher upkeep. They're going to have faster turnover where they can re-rent these. So that's what I do love about them being so heavily into downtown Toronto. Again, they're showcasing their occupancy rate. It is good. Here is the split of the rentals though. Retail, 85%. That is very hefty. 10% office and 5% residential. That's been coming up. They've been focusing on that. I'm going to go over that a little bit later, but that much retail, that is just too much. And they are trying to diversify that a little bit, of course, but when you have that much retail, it's going to take a long, long time to do. This one here is what I think is one of the important growth stories here at Riocan here. They're building up a residential unit, Riocan Living basically. And this has started from nothing 5, 7 years ago and it's gotten up to 5%. You can tell it's going to take them a long time, but this is something I think they're going to probably spin off 4 or 5 years from now once they build it up. But they have 14 buildings, 3,000 units from back in 2018 when there was 0 units. They've got 3,000 units now. These are just rentals or luxury rentals, which is great. They're all in the major markets, high occupancy. There's just no rentals anywhere in these major cities in Canada, so I don't think they're going to have a problem with that. And they're all new buildings, average age 3 years. That's perfect. And they're really scaling this up. I do think there's going to be some sort of spin out on this one. Again, I think it's like 4 or 5 years out from now. They got to build that up more. So something you look for if you're long term. The development pipeline, I'm not too worried about that. Payout ratio, free cash flow. So yeah, you know what? They do have a good dividend yield. It's over 6% right now, 6.2, and their payout ratio is around 62%. Again, that's good. Here's the maturity of their debt. You can tell in 2025, 2026, a lot of it's coming back up for renewal. These are probably ones that are going to be paying a couple basis points higher, even with our planned. I do think interest rates are coming down a little bit this year. I think we're going to get a couple cuts in 2024, but look at all these renewals coming up the next couple years here. So they need interest rates to come down. They've probably got these ones in around like 2-3%, and they're going to be renewing around like 6%. So they're going to be paying a big chunk of money right here. So this is something you have to be thinking about. But that stock chart, I'm just not into it. I honestly don't think this is a buy. I might just keep holding on to what I got since I've had it for a bit now. But you're probably better off just to get into like an all-in-one ETF. So I'm not into it. I don't think I'm going to add any more. I don't think I'm going to sell it, but who knows? If I find something better, I might. But that's a quick little look into Riocan REIT. Let me know what you think in the comment section below.